this time of year, as we're moving into fall, we start to see a seasonal slowdown in the real estate market. But that isn't really happening this year. I've talked about it the last couple of months, and the real estate market is still going very, very strong overall, and right now doesn't show any signs of cooling or slowing down at all. Hi, this is Andrew with the Andrew Smith team at eXp Realty, and I'm going to run through my October real estate market update here, and we're going to touch on the latest aspects of the real estate market itself. We'll go in a little bit on unemployment, take a look at the rest of the economy, especially as it has to do with consumer spending. We'll touch on inventory and home prices and review the latest in mortgage forbearances. So there is absolutely a lot to cover. So, although there's been some questions as to what type of economy or how the rest of the economy is recovering, as First American points out, there isn't really any discrepancy when it comes to housing. Housing has experienced a strong V-shaped recovery, and it's now exceeding pre-pandemic levels. So if we think about that, even with the shutdown that we had with the COVID restrictions and the pandemic, we've now come back to a level that is actually exceeding where we were going into it. Yes, it was the beginning of the year, but still, all things considered, that's a pretty remarkable feat. It's kind of shown here on this housing market recovery index. So this index is made up of four components, as you can see on the graph: demand, supply, price, and time on market. So this is plotting back to near the beginning of the year in February all the way up to September. The V that we just referred to is clearly visible in this particular graph. So you can see the year started off and we got up to a recovery index number of 106.5. We dropped to a low point of 83.1 right there at the beginning of May. And now we're running at 107.2. So again, we've exceeded that level. So housing is just still going gangbusters. If any of you have been out there looking to buy a home, you've experienced this. We're seeing it in North Texas, here where I am, as well as in Southern California, where my other team is, but also across the country for the most part. Now, some of the key changes that we're seeing year over year, I mean, these numbers are just amazing, to be honest with you. Showings are up 60.7%. New purchase applications are up 25%. Those deals under contract, pending deals, 21.8. Existing home sales are up 10.5%. New home sales, I mean, the builders are having record years, and we're going to talk about why that is in a little while. They're up 43%, but look at inventory. And well, that's actually why the new home sales are going nuts. Inventory, we're starving in the market for inventory. Existing home inventory is down 39%, and new home inventory is down 33%. So with all of this going on, it begs the question, can we keep this up? Can this continue? It's been going very strong. Spring basically got pushed into summer in the real estate market, and summer is now being pushed into fall. So how long can this continue? Well, to be honest with you, that depends on the overall economy. When we move outside of just real estate and looking at the overall economy, it is coming back faster than many people had imagined. At least that's what most of the experts are saying, and they are forecasting that much of the recovery that we're seeing is going to continue. Have there been some blips? Have there been some slowdowns? Yes. But the general consensus is that we keep moving in the right direction. And one of the areas where this is seen is in consumer spending. One of the items that is tracked very carefully with regards to overall economic health. So if we use January 1st here as a baseline, you can see that by April 1st, consumer spending was down 31.7% overall. As of September 1st, it had recovered all the way back to only being down 4.1%. So obviously, you'd like to see consumer spending going up, but where you consider where we've been and where we are now, again, that is starting to look a little bit more like a V than was originally expected. There has been talk that we're going to see a swoosh, which would mean the top end of that green graph there will start to flatten out a little bit, but that remains to be seen. Now, if we look at that change in consumer spending across all of the United States, it's kind of showing an interesting picture here. So, the all of the goldish brownish color, goldish really, that's showing that consumer spending in those states is still down 0 to 10% from where they were on January 1st. States in red are still down in excess of 10%. Some of those states have had some of the strictest lockdowns, so that can explain some of that. The states in the light blue, that's showing that consumer spending in those states is actually up 0 to 10% from where it was on January 1st. And the only state showing greater than 10% is Rhode Island. They're actually up 18.1. But you can see overall, this is the trend that we're seeing moving forward. For the United States as a whole, consumer spending is still down about 3.8% currently. All right, so let's move into unemployment because obviously that's going to have a big impact on it as well. So, we're currently tracking as of September at 7.9% unemployment. Is that great? No, by no means is that great. It's not where we want to see things at all. But it's a lot better than where we thought we were going to be if you look at the time period. So, you look at March, it started to tick up, and then, the hammer dropped in April, so to speak, when it shot up. And we've been coming down every single month since then. And most of the experts are saying that they expect that continue. Everyone acknowledges that the pace of economic recovery in terms of unemployment, so the pace of unemployment has slowed, meaning the number of people going back to work has slowed, and the unemployment rate is not coming down as quickly as it was. But again, they're expecting that the decline in that unemployment number will continue moving into next year, especially if the economic recovery that we are seeing continues. So, with unemployment, what goes hand in glove with that, especially in terms of the real estate market, is mortgage forbearances, the potential of foreclosures. That's been on a lot of people's mind. It's had a lot of buyers wondering, what do I do? Should I still move forward? Should I wait a year? And, I don't have a crystal ball, but here's what I do know. The number of homes in active forbearance continues to decrease. So we held stagnant at 3.93 million for a while in the weeks in August, but since that time, it has started to come down again. That is kind of mapping what we're seeing in unemployment. It makes sense. As unemployment reduces and people go back to work, they then are able to restructure a lot of these loans with their lenders. Is it perfect? No. Are there going to be foreclosures? More than likely. But there's foreclosures in every single type of market every single year. Does it look as though there's going to be a massive wave of foreclosures hitting us? No, it doesn't. And I know a lot of people keep saying this is 2008, 2009 over again. I've been saying for a long time, no, it's not. I did foreclosures and short sales during that time, and the signs right now are very different. And there's also some other key differences in the market. So this one here is kind of interesting as it looks at inventory. So look, you go back to 06, 07, 08, 09, 10. Look at what the inventory was. I mean, we were way up in that red zone, meaning a buyer's market. There was an abundance of homes for sale. When you have an oversupply and then people had lost their jobs, unemployment spikes, and you have softening demand, prices fall. That gets people behind the eight ball. A lot of people had no options except to give their property back to the bank. Look at where we are right now. I mean, since about 2012, we have been in a strong seller's market. I mean, inventory is so much lower. So the reason that prices keep going up these days are that demand is high. We showed a few slides ago, purchase applications continue to go up, and inventory is low. Again, low supply, high demand, even with the unemployment, continues to push the real estate market forward. The other difference between where we were then and where we are now is equity. So look at this, 42.1% of all homes in the United States are owned free and clear, right? That's a massive number. Then you look at the number of homes that are owned or have at least 60 to 99% equity is 16.6%. So when you look at this pie chart here and this breakdown, the amount of equity that people are sitting on right now is huge. They're huge numbers, which means options are available. If someone truly gets in trouble, then they're able to do some different things that they were not able to do back in 08, 09. Short sales existed because there was no equity. They were going to end up short in that transaction. That's not the case for the vast majority of homeowners in the marketplace today. You know, Bill McBride of Calculated Risk says this. This is very different from the increase in delinquencies following the housing bubble, right? Lending standards have been fairly solid over the last decade, and most of these homeowners have equity in their homes, and they will be able to restructure their loans once or if they are employed again. So, very, very different. Will there be foreclosures? Yes. Will it be a wave of foreclosures? I don't see it, not based on the information that I have and that's being made available to me. So, what does this mean with regards to home prices, especially for those that have been considering buying? Should you wait? Well, you already know that interest rates are just about at record lows. And here's the projections for home prices going forward, right? These keep getting revised up, not down. So almost all of the major entities here, Zelman, Fannie Mae, NAR, Zillow, the Mortgage Bankers Association, a Reuters poll of top economists, Freddie Mac, CoreLogic, are all expecting home prices to continue to increase over the next 12 months. Only Haas is forecasting a slight decline. It's going to be interesting to see how long they sit on that potential decline as the data comes in, keep showing the recovery as it is moving forward. Now, why is that? Well, as we said, prices are a simple factor of supply and demand. There is limited supply and demand continues to be high. So, according to Realtor.com, since the beginning of the COVID pandemic in March, nearly 400,000 fewer homes have been listed compared to last year, leaving a gaping hole in the U.S. housing inventory. As a result, home prices are accelerating at double the pace we saw a year ago. So, again, when you have that much demand and that little supply, prices have nowhere to go but up. That one of the dangers that we face will be affordability at some point in time. The falling interest rates have offset that so far. But if those interest rates start to go up anytime soon, even though they're not forecast to, and prices continue to go, then affordability, especially at the lower end of the market, is something that we're going to need to watch going forward. So let's look at this year over year change with regards to listings. So the green line here represents the new listings. So you can see compared to a year ago, new listings continue to be down, right? So it started to level out a little bit as we've moved into September, especially over the last couple of weeks. But when you look at the orange line, overall listings in the market, even though there's new listings, cannot keep up with the pace of demand and then the rate that homes are selling at. So nearly 40% decline in the number of total listings for sale, which kind of shows, going back to the builders are having record years. They're doing everything they can to fill that gap. Yes, they've been slowed down. Yes, there's lumber prices are way up. So the builders are being forced to increase prices, which is going to have an impact. But again, the biggest thing holding the market back right now, the biggest obstacle we have is inventory, which is why if you have even remotely been considered selling, it may be a time to look at that again. There's options out there for you, and there's plenty of buyers in the marketplace. So there's a good opportunity for you to sell for the most amount of money in the shortest amount of time. Now, I'm going to close today just on the inventory factor here. So if we look at this with existing homes, sales of existing homes year over year are up 10.5%, but number of listings are down 39%. Now, on the new home side, take a look at that. Sales of new homes are up 43% year over year, but the number of new homes available is down 33%. So there's a huge imbalance between listings and sales. And that's the balance that we need to try and bring back. It's not healthy or good for us to stay in a extremely strong seller's market forever. We've been in one for almost a decade now. And it would do the market good to see that balance out a little bit. So again, if you've been considering selling, it might be a good time to put that house on the market. So obviously, many of these numbers I've given here are a little national, or they are national in their perspective, and those numbers change not only from city to city, but neighborhood to neighborhood. So if there's questions that you have about what the market conditions are in your particular neighborhood, please reach out. I'd be happy to put some custom data together for you and share that information. In the meantime, I hope you have a great month, and we'll catch up to you next month for the November market update.